If you see an investment banker on the street, they'll likely be sporting a smile bigger than when they got to pick the Wolf of Wall Street for the Christmas Day movie. The biggest banks in the US have reported stellar earnings over the last few days, crushing analyst expectations and painting a bullish picture of the economy. Deals, deals, deals. Among the banks to report BOFO quarterly results this week, Goldman Sachs said a surge in dealmaking has supercharged the industry, which is apparent in the gangbusters numbers major banks have delivered. Goldman said its third-quarter profits jumped 37% to $4.1 billion, putting its main investment arm on track to deliver its best year ever, though the bank also announced an upcoming round of layoffs. Citigroup's profits were up 16% from a year ago. JPMorgan Chase reported a 12% jump, and Bank of America was up 23% YOY. Morgan Stanley shot past expectations with a 45% jump in profits from last year, with its quarterly trading revenue even higher than rival Goldman's. But money is really only moving around at the top. The health of big banks is often seen as a signal for the whole economy, but there's a catch to all this good news. While corporate deal-making and investments ratcheted up this summer, spending at the bottom seemed to freeze, with consumer deposits growing, but consumer lending demand staying in a holding pattern. The trend mirrors Fed data released last month, which showed that the top 10% of U.S. consumers made up nearly half of total consumer spending earlier this year. Looking ahead, there's a chance the good times won't keep rolling for these banking giants. Concerns about the private credit market have been growing after the collapse of wildly indebted auto lender Tricolor and car part supplier First Brands. Plus, industry vets like JPMorgan CEO Jamie Dimon have warned that market valuations are nearing bubble territory. Journalist Andrew Ross Sorkin, who specializes in market crashes, said he's nervous about unsustainable stock prices.